Every product or service provides a distinct advantage or a disadvantage to the user, really based on how the user puts it to work. Yes, I call this the paradox of a knife. The simple example is that a knife in the hands of a murderer will take a life, and the same knife in the hands of a skilled surgeon will give life to a dying patient. Like the knife, it's not the life's fault that somebody dies and somebody lives. It's really how the person puts it to use. Similarly, in the case of investing as well, there are some very clear-cut ways in which we can make investments work for us, especially mutual funds. In the last 4 or 5 years, we have seen enormous amount of people get into the mutual funds, and they've also benefited, many of them, but also a few of them have lost money. In today's video, we're trying to give you a rundown of the 12 costly mistakes that you should avoid while investing in mutual funds. First, you must never start investing in a long-term equity mutual fund unless you have provided for what is called an emergency fund. The emergency fund is really the first investment an investor must make. The emergency fund is essentially a fund that comprises of anywhere between 3 months to 9 months of one's monthly expenditure. If you're working in a job or if you're running a business, whatever be your nature of work, you must keep this emergency fund in a bank deposit or a liquid fund or so on and so forth, so that you have access to the money when you need it. Without doing this, you must never start your long-term investment journey, because in case you need money urgently, you should not go ahead and break your long-term investments. It could prove very costly. People who didn't do emergency investments during the period of COVID had to break their long-term equity investments when the markets were down and really lost a substantial amount of profits that they should have gained otherwise. So the emergency fund is really the first one should start. Second, if you're a youngster starting your journey of investing, I would recommend that you do your risk management first. So you should take a reasonably good term insurance product. You should also be covered with health insurance before you really start putting aside long-term money in the form of SIPs or whatever be it. This way, you are ensuring that your risks are mitigated and then you're providing for your long-term gains. So second step is to make sure that you have provided for risk mitigation. Third, investing works best when it is aligned to a financial goal, be it a retirement goal or a house purchase goal or children's education goal, whatever be the nature of goal. It makes a lot of sense to align investments according to the goal post. There is a study that says 90% of all the investors who aligned their investment to goals were able to achieve it, which means that you have a very strong chance of achieving your goals if you align your investments to the goal post. Fourth, looking for a right time to start. I have seen endless amount of people who are constantly waiting on the sidelines. Markets appeared high 20 years ago, markets will continue to appear high today. Believe me, there is no right time. When it comes to investing, yesterday is already late, tomorrow is even later, today is the best time. Get going and get started. As long as you have a reasonably longish horizon, no time is a bad time. Next, before investing, it's important to understand your risk temperament and align it with the investment product. If you're somebody who doesn't like too much of risks, is afraid of market volatility, then you should get in more of your money into products that are in safer buckets. It's extremely important to align your investments according to your risk temperament, because you should not lose sleep while investing. Next, you should invest rightly, meaning that you should not under-diversify, you should not over-diversify. If you put your money in too many investment products, you will not have the ability to track all of them, and therefore some of those investments may not yield optimum results. If you invest in too little a number of funds, then you are under-diversified, so you don't get the benefit of diversification. So it's important to get that right mix going for you. Next, do not look at what your friend is doing and follow his footsteps. This is called herd mentality investing. And many a times in stock market, you will find that people try and follow a trend. So if today there is a certain trend of people investing in a certain sector, then everybody runs that way and puts money. I don't think it's a smart thing to do. It's important for you to check out if that suits your requirement. And if it does, then go ahead by all means. But if it does not, don't do it just because your friend is doing it. That's not a smart way of investing. Next, check out the fees, expenses, and exit loads. Most mutual funds offer 1% exit load, especially equity funds if you withdraw the money within a year. Between regular plans and direct plans, there is a difference in pricing. So if you're going through a regular plan, you must know that there's a slightly higher price you're paying for it. And therefore, you are entitled to a certain amount of services that the distributor promises you. Exactly the same way, the taxation rates depends on the tenure of your stay. In equity funds, if you stay less than a year, you end up paying 20% of the gains. And if you stay beyond a year, your taxation is 12.5%. Also, up to ₹1,25,000 rupees of capital gain every year is tax-free for you. So you should use these tools to gain a tax advantage for yourself if you want to continue to stay invested in equity funds. Next, while past performance is extremely important while making your investment, it need not be the only criteria based on investments. Past performance provides you useful data in understanding how the fund manager has navigated the past, but that does not necessarily define the future performance. So don't go entirely based on past performance. Sometimes funds just go through a cycle where they have been through a bad time and they're just getting started getting into a good time. So it may not be a bad idea to look at funds which have not had a great history but have a great future. Next, do not do emotional investing. Do not look at market volatility as a reason for you to enter and exit markets. Use your goal post or your financial needs as the true north for your investments. Emotional investing is watching news or watching TV and pulling out money every time the market tends to be volatile or falls. Equity investing, especially stock market investing, will always be volatile. The markets are never going to be straight. They're always going to be falling and rising. So every time markets fall, if you pull out your money, I don't think it's a very smart thing to do. You're not going to make money. You must maintain a monk-like calm when markets are going through these cycles. In fact, you should use these opportunities to top up your investment so that they perform even better. Next, you must use review as a conscious basis. These are not fill it, shut it, forget it type of things. You must put your money in, but at least once a year you must go back and review how your portfolio is performing. You must use rebalancing tools to rebalance it in some form so that you're not overexposed to one asset class and you have a fair balance going for it. Last but not the least, you must develop patience. For getting the greatest return, you must be prepared to wait patiently in the long haul. Equity investments are all about patience. If you stay invested in a good investment product over a long period of time, believe me, you will make a tremendous amount of wealth. On the contrary, if you are consciously pulling out your investments in short term, you're going to tend to lose money all the time. So if you're somebody who cannot be patient with your investment, mutual fund is not the place for you. So these 12 mistakes that you must avoid while making investments in mutual funds, I'm sure you will make a great return for yourself and create wealth.